to Tech Wealth Chronicles, a podcast by Crispidea, which is an AI-first wealth management firm. Tech Wealth Chronicles is a podcast about real stories behind real numbers and real wealth creations by ambitious professionals, and more so of these ambitious professionals who are focused on technology as a sector. And today, for one of our first episodes, we have got Nilesh Naik over here, who is again a very senior professional having more than 3 decades of experience having worked across multiple organizations ranging from Lucent, Saskin, Cradlepoint from Ericsson and Unisys. And Nilesh is someone that plays a long-term game, as I can say. With having such a accomplished career, Nilesh is a head of senior director in the engineering function with multiple of this organization. And where he specialized in telecommunications as well as he is in a computing domain as well. Nilesh is someone who has got bachelor's in engineering, and he has got a general management degree from London Business School. Welcome, Nilesh, once again to this session, and thanks once again for being part of this podcast.
Thank you for having me in this podcast.
So, Nilesh, let's get started, and of course, I tried to summarize your experience in from my standpoint to the extent possible, but would love to hear in your own words, your entire journey, both from a career perspective and a wealth management perspective. Can you give our viewers a brief idea in terms of how you have, evolved in your career, both from a career as well as the wealth management perspective?
Sure. So yeah, I mean, everyone's wealth career, wealth journey is different, and mine was pretty much different from everybody else as well. When I started my career, I of course invested in what I knew the best, and that was fixed deposits. And at that point in time, the whole thought process was, while it does not give a lot of returns, but at the same time, it was also an investment which helped me in saving. And over a period of time, of course, I got introduced to other instruments as well. So, for instance, my friend introduced me to the stock market, and I jumped into the bandwagon.
And which year was this, if I may?
This was in the 90s. Okay, early 90s.
Harshad Mehta time frame.
Exactly, just around that time frame. I then realized that while earlier I was talking about perhaps saving and security, the stock market was giving me perhaps an instrument which can help me to grow the wealth. And from that perspective, I thought that it was obviously a better way of investing, but then also required a lot of research. I just, was earlier picking up stocks based on hearsay, but then it required a lot of research. Over a period of time, of course, it was really the mutual funds that I got introduced to. And then I realized that, yes, stock picking is best left to the experts. And that is what really helped me in also, diversification and now there are so many classes. But obviously, my wealth journey, if you really look at it, it's evolved from fixed deposits to stocks to mutual funds. But at the crux of it, it's really about how can I make sure that you continue to grow the wealth to at some point in time reach the financial independence.
No, it's amazing the way you described it. In fact, I somehow thought about mutual funds and especially becoming popular with mutual fund SEBI, etc. But probably you have been investing even before this slogan and the campaign and the kind of the extreme exponential rise that we have seen post-COVID. Mm-hmm. It seems like you have been investing in mutual funds even before that.
Yeah.
But how do you align, how did you align to some of these asset classes and investment philosophies? Maybe if you can tie it to the different stages of your lifetime as well. Mm-hmm. And then just for viewers, I just want to mention that Nilesh is a father of 2 daughters who are all already in their early 20s. So I'm sure, there are stages in life that you have gone through. And then maybe if you can just align, your wealth management philosophy to different stages of life. I mean, for our viewers, I think that would be fantastic.
Yes. So, maybe I can start with, how it was when I was very young, right? I mean, it really comes from childhood. and a lot of that is really dependent on what my family philosophy has been, right? And there it was more about safety. Financial security was, of course, the key at that point in time, and that was the fundamental aspect of investing. So if you look at my parents, the way they've invested, they have been very conservative in terms of investing, and their journey has been more about, how can we make sure that there is financial security. Um, that has evolved over time, okay, and I realized that while that was a good starting point. Obviously, it is important to start looking at how can we not ensure that inflation can erode the value, and that really helped me to invest in asset classes which are just beyond debt instruments, and that is really what has helped. And one of the things, as you talked about, it's also important to make sure that you have investments in different asset classes, and there's a lot of diversification which becomes all the more important, right? And asset allocation. So I've been really focusing around making sure that while the journey started with something which was very safe and secure, how can I make sure that I can move into areas where there's a lot of growth that becomes all the more important as well. And that's how typically I've been looking at asset allocation.
No, that's fabulous. And I think the entire journey in terms of shifting from, wealth preservation and leveraging, debt instruments, like you mentioned, FD, and then moving into, the asset classes which are considered as king of asset classes, which is largely equities. I think of course, there's been a shift. But when did you realize that you actually have made it, right? I mean, from a wealth creation perspective, or even from a goal perspective, maybe if you can
Sure.
kind of maybe talk about the stage in your life where you thought you have kind of been there, and you're now in a relatively a lot more secure place where you can take much higher risks
Sure.
as well.
I don't think there was a single moment where I can say that I'd reached, the financial independence, but maybe there were different milestones. I think one of the milestones was perhaps when I reached the 25x rule target, right? So which is essentially says that if you have a corpus which is equivalent of 25 times your annual expenses, then that can really support you for a lifetime. Okay? Maybe it's 30x if you look at Indian context. But that was perhaps one instance. And when I realized that, then it is really about, you start looking at how can I use my time more effectively than just working for money. Perhaps the second instance or second moment was when I go shopping, right? And I'm not talking about big ticket purchases, but you look at shopping or you go to a restaurant, you don't start looking at what are the prices, and that's very different from how I was earlier. I used to actually look at the spending up to the very last rupee. But over a period of time, I realized that you feel that at this point in time, it's more about giving higher value to perhaps other items, the big ticket items, and some of the smaller ones. You reach a stage where you don't perhaps want to spend too much of time on these things, but start looking at the bigger picture.
No, I think that's a fabulous way of looking and experiencing the life as well. And maybe would you be able to share like any kind of books or quotes or mentors that kind of influenced the way you started thinking about the wealth and financial planning creation? Would love to hear what kind of shaped that thought process, right?
Sure. So there are quite a few books on wealth management that I've read, but what I would like to really maybe focus on, especially for your viewers, are really the classics, and those are the ones which are, I would say, very evergreen and still very relevant. One of them was this book called Rich Dad, Poor Dad. Okay, by Robert Kiyosaki. That really talks about the fact that how do you build passive income over time, right? It says that you don't really work for money, but how can you make money work for you? And then that concept was quite profound, because at the end of it, it's really about how can you make sure that you're building the right assets, so that it can serve you for the lifetime through passive income. So that book is absolutely a classic, and I would really recommend your viewers to read that.
Absolutely.
The second book, which really changed my thinking, was a book called Psychology of Money by Morgan Housel. It focuses on the fact that wealth is not just about numbers, but it's about behavior. And that concept of saying that how can I make sure that you start when you look at investment which is really for the long term, and you start building rather than looking at a one snapshot of an instance. But it's about discipline,
Right.
right? How does the behavior influence the way of investing? So discipline and making sure that you are invested for the long term was absolutely an eye opener there.
Right.
But really, one book which has challenged my thinking, challenged my mindset completely, was this book called Die with Zero by Bill Perkins.
Okay.
Okay, it actually opened up my eyes completely into, what he says is balancing wealth with life experiences. And that was amazing because he says that, well, it's not just about accumulating wealth for the long term, but how do you start also using wealth for life experiences at different stages of your life,
Right.
and how can that really that was a complete an eye opener for me. I think it is a fantastic book. Really talks about look at different phases and not just keep accumulating wealth just for the sake of
Oh, that's indeed fabulous, and I think you kind of rounded up, quite well, right? I mean, it's all about saying, how do you generate the passive income? How do you create long-term wealth, and how do you bring in the behavioral part of the, finance into the psychology of money, and then the third is money and wealth is not just about accumulation or the right strategies, but it's also about life experiences, right?
Right.
So you kind of rounded up very, very well. So thanks, Nilesh, for that. So we'll continue, Nilesh, with more questions. You talked about some great books and the lessons learned from those books, but sometimes, life teaches you even bigger lessons. From a financial investment perspective or broadly from your wealth management perspective, were there mistakes that you actually made in your life, right, that taught you a lesson?
Oh, definitely. I mean, I perhaps have made more mistakes than I'd like to admit. Well, one of the mistakes I made was investing based on somebody else's advice. Right now that obviously, in the beginning I used to do that without doing my own research. Just go and buy stocks with somebody else
like
suggests,
tips.
and go with the hype. Yeah, but those tips don't really work, and I'd like to say that I don't think any of those actually made a lot of sense or money. But then I realized that it's the core of investing is really understanding the fundamentals, right? And only when you do your research and then understand the fundamentals well is really the key to investing. So that was the first mistake. And the second mistake was really sitting on the sidelines and watching and not acting. Now this is a problem because you've seen that when the market goes up, you obviously feel that there's a FOMO, right? You should have acted on the market. Or when the market goes down, there's a fear. But then I realized that it's only when you are constantly invested and you invest on a regular basis that becomes all the more important. I mean, it's at the end of it, it's really about making sure that that while looking at financial growth, you're also making sure that you sleep well at night. Right? So it's a combination of those two things. But yes, these are the two things I would like to which stands out.
And Nilesh, I mean, you have seen, of course, multiple down cycles, probably more than some of our younger viewers. But you would have seen the .com bubble. You would have seen Lehman crisis. Of course, COVID. Maybe most of us have seen. But were there any lessons from any of those kind of downturns, or either positive or negative, that you want to share?
No, absolutely. I think those are definitely instances in life that teach you really wonderful lessons. And I would say that one thing which has helped me in doing is making sure that I have a fair bit of diversification and also rebalancing. Now, this is important because when you are looking at, take diversification for instance, right? You're not putting all the eggs in one basket,
right?
Right, and there are enough and more instruments today where you can really spread your investments based on your risk profile.
So you're talking about rebalancing.
So rebalancing is important as well because what essentially happens is you have obviously made certain asset allocation, and then you find that certain assets are going up, and that sometimes throws your balance off, and then it's important to bring back. And that is extremely important. So diversification assets allocations are, I would say, two important, constant churn. I wouldn't say constant, but at least on a regular basis, you need to make sure that you are watching.
Right.
Otherwise, the market. I mean, there's a lot of, I would say, stock market. The whole philosophy is about entropy. right? There's so much of fluctuations, and you just need to make sure that that doesn't impact you much.
True, true. Wonderful. And I think on the asset allocation, I want to pick up the thread because I think you earlier also talked about, asset allocation in terms of moving from FD to stocks and mutual funds.
Correct.
But of course, one of the things which as us as financial advisor, which we advise to all our clients is, keep changing your asset allocation as you move towards your retirement. You should shift more towards debt, and initially you can probably take much higher risk with equity and so on and so forth. But in reality, does it actually happen? And are you able to stick to a certain asset allocation plan? And how have you shifted over a period of time as well, right? From your own personal experience.
Sure. So as I had mentioned before, my investment journey started with fixed deposits.
Right.
So
other way around.
Obviously the other way around.
Right.
And then as I started gaining more knowledge,
right,
and I started doing my own research, I started moving towards equity. There is this 100 minus X rule, which says that, X is your age, and that's the amount that you should have in equities. Well, I feel that, there's a fundamental, I wouldn't call it a flaw, but it all depends on your risk profile. Okay, to me, for instance, I'm perhaps more equity heavy because I'm really looking at investing for the long term. At the end of it, what is really important is how comfortable are you with the type of exposure that you have to equity, rather than just following these rules.
Right.
So in my case, for instance, I started with debt, more fixed assets and perhaps lower returns but higher safety.
Right.
And then I moved into more risky returns with higher growth. But then it's a combination of those two. But I really, as I said, I'm perhaps more equity heavy.
Yep.
But then asset allocation, diversification, and rebalancing becomes.
And I think you're making a great point, because I think what you are saying is, I think you talked about two rules, right? You first talked about 25x or 30x. And I think in some sense what you are saying is, once you get to that 25x or 30x, then the rule of 100 minus x doesn't apply as much, because then you are in a zone where you can potentially take much higher risks.
Correct.
And hence maybe then you look at more in terms of your own individual comfort, and then how do you drive asset allocation according to your risk profile.
So one of the things which I normally follow is also the bucket strategy, right? Based on what goals that you have in life.
Right.
So obviously, so we look at something which is more short term, medium term, and long term. And I always look at what I call as short term liquidity, medium term stability, and long term growth. Right. So as long as you are having a focus around making sure that whenever you need the money, you have that in the right bucket. I'll normally look at more of a long term investing than something which is really speculative and short term.
Well, that's absolutely fabulous, and I mean, so many nice lessons to learn from that standpoint. But I just want to ask a question, because as you rightly mentioned, I mean, it's been a journey for you over several years. But when you made your first big financial decision, and I'm not sure what it was, whether it was like a big car purchase or a stock purchase, or like the big decision that you made, right? How did it shape your mindset about money? In terms of making that particular decision, how comfortable you were with, what were your trepidations, if you may maybe talk about that.
Well, I think the first big financial decision was obviously buying a house. Right. And
which is like typically the biggest, one of the biggest investments. Yeah.
That actually helped me a lot in, I would say, more understanding and planning the cash flow. Right? Because for me, buying the house was not really an investment. It was more about financial stability.
True.
And when I talk about cash flow, making sure that you have the right amount for down payment, and then there are EMIs, there's maintenance, there's a whole lot of, it's really for the long term. So the planning around the cash flow was really how it helped me. And then in some ways, it actually helped me in sort of long-term investing, right? Taking that journey towards long-term investing. But again, going back to, what I had said, buying a house or buying a very big investment was more of financial stability than really looking at that as an investment.
Understood. And I just want to pivot off one point, because I'm 48, and I think a lot of the real estate decisions that we made were either in late 30s or potentially early 40s, etc. Some of the next generation wants to potentially buy real estate much earlier in their lives. So I'm also seeing a change in the thought process and the behavior towards money. But as you look at different generations, right? I mean, of course, the way your parents thought about money versus where your children are thinking about money. Like, what are the changes that you are seeing, and how they are looking at investments and money differently?
Yeah.
Maybe if you can talk about that as well.
Sure. I think at the end of it, if I really look at the thought process or the journey, right from how my parents looked at it versus how the current generation is looking at it, it's been so very different.
Right.
And that's because it's evolved, right? This whole thing has evolved. If I look at my parents' generation, the focus was really about security, the financial security, right? So it was more about saving with security. So their focus has been really about making sure that you have investments in the instruments which may not give you high returns,
right,
but at the same time it does not. I mean, it really provides safety.
Right.
So that's been the thought process, and the instruments were more FDs and debt instruments. If you look at the current generation, right, we are looking at more about investing over saving. And that obviously means that we are now perhaps taking slightly higher risks.
Right.
We are looking at investing in equity. We're looking at, and there are so many instruments that we can really invest in. But at the end of it, it is really about making sure that we are able to invest more than at least giving a good alpha over the inflation, right? But if I look at the next generation, which is my kids,
your kids, and
they are focusing more on experiences than just accumulation. And I've seen that for them it's really about smart saving, but they are looking at earning and spending smartly,
right,
making sure that they have the right life experiences,
right,
rather than just making sure that they're accumulating wealth.
Right.
And that's a big shift between, and that shift is perhaps because of the way things have evolved, the way the world has evolved as well. But I'm seeing that significant shift in the thought process, right, between how my parents invested and how the current generation is investing.
Right. No, which is fabulous. And I think, of course, from a wealth management perspective, we have been doing goal planning, for example, but kids are maybe looking at more flexible goals,
Correct.
And the goals
Correct.
keep evolving as well as they kind of accumulate more wealth and more experience as well. But if you have to kind of, at this stage in your life, right, if you have to name top 3 goals for you at this stage, what would those be? How close you are to achieving them? What kind of wealth planning strategies you are still adopting from a go-forward standpoint, right, where you are in your life stage? Maybe if you can talk about that. Like retirement being one of them as an example.
Yeah, definitely. And maybe perhaps some of my goals are more focused on my kids, right? So one of the goals would be really my kids' education, right? Making sure that whenever, if they want to really do some specialized courses or they want to go higher studies, definitely we don't want to, I don't want to, get the financial stress into all that and make sure that there's enough allocation there. The second one would be, of course, giving them a meaningful wedding experience, right? Because that's a lot of...
and that's a very important experience.
Correct, because life experiences are all important, and at the same time, how do I again make sure that that there's enough coverage? Because when we look at any of these experiences, you definitely don't want to you want to make sure that there is no constraint on the financial front. And the third one would be really about travel, and like you said, it's about how can I get my life experiences, right? So making sure that I have enough allocation towards travel, because one of the things I would certainly like to do, and I do that even now, is really enjoying moving around, traveling, enjoying the cuisines, enjoying the places, and those are the 3 top goals, I would say. But coming back to your question on how do I make sure that I have the right allocation, well, it goes back to making sure that you have the right buckets, as I was mentioning earlier, on each of these 3, and so there is a specific investment that is sort of earmarked for these purposes.
Got it.
That's the best way to get some peace of mind.
Got it. So you're clearly creating the buckets for each of those different kind of goals.
Correct.
And that gives you that comfort that, hey, I'm now much more closer to the goal realization, and being very clear first of all about what goals you want to have, and I think you are absolutely clear about that particular part. But were there any smarter decisions or trade-offs that you took for driving the financial planning around, let's say, some of the goals that you mentioned? Like one of the things, for example, which everyone talks about, but sometimes it's very hard to put in practice, is the power of compounding. So like for some of these goals, did you plan to start allocating money much earlier in your life stage relative to getting closer to that particular goal, etc.? Maybe can you talk about
No,
some of
absolutely.
those pieces?
While I did just touched upon it earlier about this bucket strategy, I think that's extremely important when you start looking at goals, because some of those goals, when I started thinking about these, were really long term.
Right.
And the best way to invest in a long term goal is through equity. And that was important because at that point in time, it's more about making sure that you're staying invested in spite of the market
Ups and downs.
upheavals, and you're investing consistently and regularly. That would be the critical part there, and you just put that in the bucket and forget about it. Then you have the other two buckets, right, where you look at more in the medium term and short term. In the short term, obviously, you want to ensure that there is fair amount of stability, right? And then perhaps the medium term, you are able to take a bit of a risk, but at the same time, it's more about making sure that that you are aligned to the goal that you have, and if the goals don't move, then you need to make sure that your financial decisions are accurate.
Fabulous. So Nilesh, I think you have a very systematic view of investing, whether it's in terms of the buckets or the rules that you follow. But do you work with a financial advisor, who kind of recommends you how to go about it? Because sometimes it's like, Krishna and Arjun, right? I mean, in terms of guiding you, or is it all, I mean, you have accumulated a lot of knowledge yourself that you are able to guide your strategies in a certain direction?
I absolutely work with a financial advisor. And working with the financial advisor helps me to take decisions which many times I would not have taken myself because of perhaps emotional reasons or whatever, right?
Right.
Now, one of the things which I make sure that my financial advisor understands is my investment philosophy and style.
Right.
And it's very important for the advisor to really invest based on that rather than pushing products which I would obviously not want that to happen.
Right.
So my risk profile, for instance, should be well understood by the financial advisor.
Right.
And he provides the right advice based on these three things, right? Risk profile, and my investment philosophy and style.
Right.
So that is one thing which I definitely feel that works quite well. And as I said, it works well because there is this, this constant prodding at different points in time. And many times we are so busy that we may not even, it doesn't come to us
naturally, right? And because it can get deprioritized in your day-to-day chores and other life priorities, right?
Yes.
So, this is a very important part.
And that helps.
But what is the most important attribute that you look in from of the financial advisor? You did talk about a couple of the points here, like things like understanding your risk profile, understanding your investment style, so on and so forth. But have you worked with the financial advisor over a long period of time? How did you build trust? How did they earn your trust, and so on and so forth, right? So are there other attributes that you look at?
So right from the beginning, what was important is that I work with the financial advisor who knows me, knows my style very well,
right?
And somebody who works with me over a long period of time.
Absolutely.
Because I'm actually, I definitely look at long-term investments than something which is more short-term.
True.
And that's why it becomes important for the financial advisor to work with me over time. And make sure that he understands my goals,
right?
And he can allocate the right, he can provide the right perspective and the right strategy,
right?
For all these goals, and that becomes important. So somebody I've worked for quite some time,
right?
Lovely, and that really helps.
Great. And if I may ask, what's the best piece of financial advice that you could have either received from your advisor, or maybe potentially your other mentors, or your family members, or your colleagues, or But if you can just talk about what's the best financial advice that you have received, and what?
Yes, the most important advice I received from my financial advisor was keep emotions out of investing. I remember the advisor telling me that that at different points in time, you will find that the stock market will test your patience.
Could disappoint you.
It can disappoint you. It can challenge your emotions.
Right.
but don't let it dictate your decisions. And that is very important because we have seen this constant churn happening. But what is really important is how can we be more disciplined in investing and just remain invested. And that really helps because and that's why the financial advisor helps in in making sure that you're able to take the right decisions and not get driven by the emotions, because many times that happens.
Right.
Typically, when the market goes up, you obviously feel the hype and sometimes the FOMO, and then when it goes down, you have the fear.
Right.
How do you make sure that those
Right.
emotions don't come in the way when you talk about investing?
Right.
And that is a big difference.
Right.
It's almost like a health coach, right? I mean, who is like guiding you, who is making you wake up when you need to, and sometimes asking you to focus on recovery when you actually need to as well, right?
Yes.
So I think, I think that's a great way to frame it, and taking emotions out of the whole journey and being a sounding board for you, right? I mean, that's I think very, very important. So while financial advisor is very, very critical, from a relationship management perspective, from taking the emotion out, etc. Today, what's also happening is technology is also playing a very, very important role in the wealth management decision. So how do you see the role of technology coming in the wealth management space? What are the areas where you think, besides your financial advisor, who is a person, a human, the technology has helped you, in your entire journey?
Yeah, so technology has evolved significantly. I mean, if you talk about my journey in the beginning, I still remember, if I had to invest in shares, I had to actually physically go to a broker, fill those forms. Provide those share certificates, and the whole process used to take perhaps a month.
Right.
But today, with technology at your fingertips, it's so much simpler.
Right.
You also have a lot of data which is available. So there's a lot of analysis. You have trends. You have information which is available on mobile devices. There's a lot of automation that is possible through SIPs and other things, right? Which were perhaps not possible long back.
Right.
So I would absolutely say, technology has changed today. Today it's so easy to keep a track of your finances, to keep a track of your investments, and also invest on a regular basis.
Right.
So big difference that I'm seeing between when I was investing in the beginning.
I do remember when I was, again, very, very young in my early days, when we had that Harshad Mehta era, where you would get the physical share certificates delivered to you by the postman. The postman would actually stand outside your home, and he would know that, hey, you have got now the share certificates, and so you are one of those lucky person, and he would want to ask for a tip, right? So I think we have gone through that. Everything which was physical, right? I mean, right from form filling to the share certificates, and then we went into the whole dematerialized era, and now, of course, is entirely digitalized and automated, and with payments coming into the picture. I think probably 20 years back, no one imagined that we would live in this era. But now there is a layer on top of this, which is artificial intelligence, right? Yeah. So how do you see AI playing a role in investments or in wealth management? Of course, you did talk about the fact that yes, there's a ton of information now available on the fingertips. There's more information on your mobile phone now than, let's say, maybe the data centers or the servers had, several years back, right? Correct. But now, how do you see AI kind of shaping the role? How do you see potentially the robo-advisors coming into the picture? Etc. as well, and what are you experimenting with any of those, and what potential do you really see?
So obviously, when there's a lot of data, AI certainly helps. When you look at data analytics,
right?
AI has really helped in smart investing,
right?
Investing and really analyzing data to the extent which obviously human beings can't really do that, right? So there's a lot of this smart investing which has come up. And I talked about automation, but AI is helping a lot in that respect as well. Then there is this whole thing about predictive analytics. But I believe that today it's perhaps more of the hedge fund managers or institutions which are using that, but it's not going to be very far before the retail investors start getting some of those that information as well. This whole thing about AI, the algorithmic trading, but that is going to completely change the way how we're going to look at this from an investing perspective in future.
Right, and I think the great news which is happening is the capability that institutions had, a few years back, is now coming in the hand of the retail investors, like potentially you and me. Right. And I think that is leveling the field, right? So as you rightly mentioned, even the algorithmic trading, while was most popular as high frequency trading in the whole hedge fund circles, but now there's like about 80-85% of the trades which are happening through algorithms. In the United States, I think the same thing is kind of slowly picking up in India as well. So we are already seeing that kind of era coming up. But there are people who look at it in a very traditional manner, right? Like I know you like cricket and chess, but like, for example, if I were to give a cricketing analogy, there are people who like test cricket. And there are people, of course, there's a game of T20 as well. So the traditionalists still want to look at test cricket and basically, respect that form of game. But how do you see that like kind of amalgamation and do you see like two sets of people looking at things very differently from an investment philosophy and how they implement and execute things?
Sure. Well, the investment philosophies are so different, when you look at, when you talk to different people. And again, I think it's also the generations, as we had spoken earlier. Of course, at different points in time, I've been looking at this very differently. But at the end of it, what is the crux of this whole investment journey of mine has been really about long-term investing.
Right.
Today, I see, obviously, everyone wants to see how you can make quick money.
Yes.
And then that, of course, you have enough and more instruments to really do that.
Right.
But there are different philosophies, and I would say that, well, I may not subscribe completely to some things, but I'm seeing that a lot of the younger generation is really focused more on that.
Yeah. As they popularly say, how do you make $1 million in stock market?
Start with $1 billion.
Start with 2 million maybe. Right. So I think, there are all these tools available, instruments available, futures and options, and we see, keep looking at the data where 93% of the people end up losing money. So while, those instruments are available, people want to make quick money. But as you rightly mentioned, the way to creation, wealth creation over a long term is long-term investing and staying focused in the market, removing emotions out, thinking clearly in the bucket. So I think, those are all the great lessons that you are sharing over here. I have one final question, Nilesh, and which I'm very keen to hear from you. I mean, we are currently in the middle of a very interesting cycle that we have potentially seen in 2000, 2008, 2020, and we are going through this entire tariff-related gyrations in the market. But as you look at future from here, right? I mean, like, what are your biggest aspirations or concerns when it comes to investing and protecting your wealth, right? And how do you look at the kind of the macro picture at this stage, right? And things which you are concerned about could be inflation, could be global recession, maybe some of those fears now coming to the limelight, and potentially we may go through some quarters or maybe even years for that cycle to come up.
Correct.
But as you look at, from here on, right? I mean, what are your biggest kind of aspirations or fears from here on, and what's your macro view?
So if I look at aspirations, well, I think financial independence is perhaps the biggest.
Right.
Right? How do I make sure that I have generated enough assets to give me passive income over time? So that would be my key thought process on how can I really make that happen. The second one would be, how can I make sure that my returns that I get actually beat the market returns, right? So essentially creating alpha which is higher than what the market creates.
Right.
And that, of course, requires a little different approach, but now with a lot of these instruments which are available and you have a lot of knowledge and information which is available on the net that actually helps you to do that. And the third one I would say is really about, at the end of it, it's all about life experiences that we've talked about, right? So how do I make sure that all these combined gives me the time and, to really enjoy the life moments and not just about wealth accumulation and wealth building, right? So those are the three, I would say, from an aspirations perspective. The fears, yes. Inflation, of course, is perhaps the biggest. The volatility of the market is another one which sometimes concerns me, and I constantly think about how can we, but as some of these fears at the end of it, I feel are can be taken care of through making sure that you have the right discipline in investing, right, and just make sure that you're constantly focused on your goals and your investment style and not look at this as a noise. So today I always look at anything which is happening in the market could be a noise, and how do you make sure that you start focusing on what your goals are and how your investment strategies are, and let this not dictate what you're doing.
No, and I think with so much experience behind you. I think you are able to put it in a very simple manner, and I think that's amazing. That remove noise from signal, and have the experience to manage the volatility. And then I think the most important part that you mentioned, right, and which probably is also a huge takeaway for me, is that the wealth management is all about the fruits of life, in terms of enjoying the moments of life, as opposed to stressing you out, right, with everything which is happening around us.
Yes, I think the die with zero concept.
Die with zero, and I would definitely remember, and will put out that link in the caption here as well. So it's amazing, Nilesh. I mean, what you kind of walked through. I'm hoping for the viewers, it's been a great learning and a sharing experience as well. But I'll maybe just try and summarize a little bit. But I think some of the things that you talked about, I think the 25x or the 30x rule, I think a great point for someone to look at. Looking at equities from a long-term wealth management perspective, and staying disciplined, over a period of time, again, I think is a great lesson. You did talk about the whole asset allocation, where 100 minus X, may not work for everyone, but it's, something that someone has to align to their own risk profile and risk allocation. Again, a great, point that you talked about. And I think above all, right, is all about basically the reason why you are doing it all is to enjoy the moments in your life. And I think life is more important than wealth at times. So die with zero as a concept. Again, I will put out the link in the caption. But thank you so much once again, Nilesh, for being with us and for sharing your time and your invaluable lessons with us.
Thank you so much, Malay, for having me on this podcast. And to all the viewers, all the very best in your financial journey.